Your credit score is a three-digit number that has never once worked in your favor if you didn't already have one. The system that decides whether you can borrow money, rent an apartment, sometimes even get a job, requires you to already have a history of borrowing money before it will help you borrow money. It is a perfect closed loop designed by people who already had credit, for people who already had credit, and if you're starting from zero, the door looks locked from the outside. But it isn't. And the reason I'm telling you that up front is because the mechanics of building credit from nothing are genuinely learnable. They're not complicated. And once you understand how the scoring machine actually reads your file, the whole thing starts to feel less like a mystery and more like a game you just hadn't been given the rules to yet. So let's talk about what a credit score actually is, because almost everyone has a vague answer, and almost nobody has the right one. Your credit score, the FICO score specifically, is a number between 300 and 850 that a company called Fair Isaac Corporation calculates by running your credit history through a formula. Not your income, not your bank balance, not how responsible you are as a human being in any holistic sense. Your credit file, which is a record kept by three separate bureaus, Equifax, Experian, and TransUnion, of every credit account you've ever opened, every payment you've ever made or missed, how much of your available credit you're using at any given moment, and how long you've had accounts open. That's it. The score is a summary of that file, and if you've never had a credit account, your file is empty, and your score is effectively non-existent. Here's why that matters more than most people realize. Landlords pull credit. Car insurance companies in most states use it to set your rate. Employers in certain industries check it before they hire. And obviously, every lender on earth uses it the moment you try to borrow money for anything. A person with no credit history is not treated the same as a person with good credit. They are often treated worse than a person with bad credit, has a file that tells a story. An empty file is just silence. Lenders hate silence more than they hate a rough patch. So the first thing you need to understand is that the goal isn't just to build good credit. It's to build any credit, because going from invisible to visible is actually the hardest part, and it happens faster than you'd think once you know how. The scoring formula breaks down into 5 categories, and knowing the weights changes how you make every decision. Payment history is the biggest one. It's 35% of your score. On-time payments build it. Late payments damage it. A single payment that goes 30 days late can knock 60 to 100 points off a healthy score overnight. That number is not hypothetical. That is the documented range in FICO's own research. The second category is credit utilization, which is 30% of the score and the one most people misunderstand completely. Utilization is the ratio of your current balances to your total credit limits across all revolving accounts. Use $300 of a $1,000 limit, and you're at 30% utilization. Lenders like to see that number below 30, ideally below 10. High utilization signals financial stress even if you pay the bill in full every month, because the bureaus are reading your snapshot balance, not your end-of-month payment. The remaining 3 categories split the other 35%. Length of credit history is 15%, which is exactly why starting early matters even if you don't need credit right now. The longer your oldest account has been open, the better. Credit mix is 10%, meaning the bureaus give you a small boost for having both revolving credit-like cards and installment credit-like loans. And new credit is 10%, which is a penalty mechanism. Every time you apply for new credit, the lender pulls your file in what's called a hard inquiry, and that inquiry temporarily dips your score by a few points. Apply for 5 cards in a week, and you've flagged yourself as someone who might be desperately chasing credit, even if you're just being methodical. So the strategy for building from nothing isn't just open everything you can find. It's open the right things, in the right order, and then wait. The best first move for someone with no credit history is a secured credit card. This is not complicated. A secured card works like a regular credit card except you put down a cash deposit, usually somewhere between $200 and $500, and that deposit becomes your credit limit. You're essentially borrowing your own money, which sounds pointless until you understand what it actually does. The card gets reported to the 3 major bureaus every single month as an open, active revolving account. Use it for small purchases. Pay the full balance before the due date every month. Do that for 6 months and you have a credit file. Do it for 12 months and that file starts to look healthy. The deposit you put down is fully refundable when you close the account or graduate to an unsecured card. It's not a fee. It's not a trap. It is the single most reliable on-ramp into the credit system that exists for people starting from zero. Not all secured cards are created equal, and this is where you need to pay attention because some of them are predatory. There are secured cards out there with annual fees north of $75, monthly maintenance fees on top of that, and interest rates above 28%. You do not need to pay any of that. The goal of a secured card is not to carry a balance. It is to generate a clean payment history. So you want a card with no annual fee or a very low one, no monthly fee, and a straightforward graduation path to an unsecured card after roughly a year of good behavior. Discover's secured card graduates automatically. Capital One's secured card has a low minimum deposit. Do your own comparison, but understand the criteria before you start clicking apply. Now, here's the part about authorized users that most people treat as a footnote, and absolutely should not. If you have a family member or a close friend with a long-standing credit card, a card with a high limit, low utilization, and a history going back years, and they add you to that card as an authorized user, their entire account history on that card shows up on your credit file. You don't even have to use the card. You don't have to have the physical card in your hand. The account history just appears, fully formed, like it's always been yours. A 22-year-old with no credit history can become a 22-year-old with a 7-year-old account on their file in the time it takes for one billing cycle to close. The one real catch is that it works both ways. If the primary cardholder misses a payment or maxes out the card, that negative history can also land on your file. So you are tying your credit health to someone else's behavior. The smart move is to have an honest conversation about that before you agree to anything. Most people who understand what they're actually being asked for are fairly willing to help. Credit builder loans are the third tool, and they're slightly more counterintuitive than the other two, so they get overlooked. Here's how they work. You go to a credit union or an online lender that offers a credit builder loan. They don't give you money up front. Instead, they put the loan amount, usually somewhere between $300 and $1,000, into a locked savings account. You make monthly payments toward that amount over 6 to 24 months. Every payment gets reported to the bureaus as an on-time installment loan payment. When you finish paying, you get the money. But what you're actually buying is payment history across an installment account, which adds credit mix to your file and builds the same core metric that matters most. Self Inc. is probably the best-known provider of credit builder loans. Credit unions often offer them at very low interest rates, sometimes as low as 3 or 4%. And they're specifically designed for members who are building or rebuilding credit. That is not a bad price for a year's worth of clean installment history showing up on your credit file. Compare it against the cost of not having credit when you need to rent an apartment or finance a car on short notice, and it becomes very clear which side of that equation is more expensive. There's also a relatively recent option called Experian Boost that deserves a mention because it's free and it actually works within limits. Experian Boost lets you connect your bank account and adds payment history from bills you're already paying: utilities, streaming services, your phone bill, rent if your landlord processes through certain platforms, to your Experian credit file. These payments don't normally show up on credit reports because they're not credit accounts. Experian Boost changes that, at least for its own bureau. The average user sees a score increase somewhere around 10 to 13 points. That's not transformative. But if you're sitting at the threshold between a loan approval and a rejection, or between one interest rate tier and a better one, 10 points can be the exact difference. Rent is the biggest recurring payment most people make, and for most people it has never helped their credit score at all. That is starting to change. Services like Rental Karma, Rent Track, and Experian Rent Bureau will report your rent payments to the credit bureaus if you set them up, or if your landlord already uses certain property management software that does it automatically. Some of these services charge a small monthly fee. Some are free if your landlord participates. The impact is real. A 2023 study from TransUnion found that renters who added 24 months of on-time rent payment to their file saw average score increases of around 60 points. That is potentially the difference between subprime and prime territory, which translates directly into lower interest rates on everything you borrow for the rest of your life. Here is the math on that because I want you to feel the actual number. The average new car loan for a borrower in the subprime range, roughly 580 to 619, carries an interest rate somewhere around 11 to 13%. The average rate for a prime borrower above 720 is closer to 5 to 6%. Finance a $25,000 car over 60 months at 12% and you pay about $8,600 in interest. Finance the same car at 5.5% and you pay about $3,700. The car is identical. The loan term is identical. The only thing that changed is a number on a report, and that number cost you almost $5,000 extra on a single transaction. Multiply that across a mortgage, a business loan, an apartment deposit, and the lifetime dollar value of having good credit versus no credit becomes genuinely staggering. The timeline people want to hear is, how fast can this actually work? And the honest answer is, faster than the financial advice industry tends to tell you, probably because slow and mystified is better for their business model. Open a secured card today. Use it for one small purchase per month. Pay the full balance before the due date. In 30 days, your first on-time payment reports. In 60 days, you have a short payment history. In 6 months, if you have no derogatory marks anywhere and your utilization is low, you can have a FICO score in the high 600s. Add an authorized user account from a family member with a long history, and that score can jump much faster than the 6-month timeline suggests. Add a credit builder loan alongside the card, and you're building both revolving and install May NT history simultaneously. Most people who follow the sequence correctly, secured card, low utilization, full payments, authorized user if available, credit builder loan for installment history, land somewhere around 700 within 12 to 18 months of starting from zero. 700 is not an elite score, but 700 gets you approved for most things at reasonable rates. It opens the rental applications. It gets you the car loan without a cosigner. It is the threshold where the system stops treating you like a liability and starts treating you like a person, which is a low bar that the system set, not me, but clearing it changes your financial options in very concrete ways. The utilization mistake is the one I keep coming back to because it trips up people who are otherwise doing everything right. Say you get your secured card with a $500 limit. You put $200 on it and pay it off at the end of the month. You feel responsible. You're right to feel responsible. But if the bureau pulls your balance snapshot on the day before your payment posts, they see $200 of $500 used. That's 40% utilization, and 40% is working against your score. The fix is simple but requires knowing it exists. Pay your balance down before your statement closing date, not just before the due date. Those are two different days. The closing date is when the bureau takes the snapshot that gets reported. If you clear the balance before closing, your reported utilization is near zero, and your score reflects that. Most cards let you see the closing date in the account settings. There is one more thing you should know about credit inquiries because the conventional wisdom gets this slightly wrong. Every hard inquiry from a new credit application does temporarily lower your score, usually by 5 points or less, and the impact fades within 12 months. But here's the thing the doom and gloom articles leave out. When you're rate shopping for a mortgage, an auto loan, or a student loan, multiple inquiries for the same type of loan within a 14 to 45-day window are counted as a single inquiry by FICO. The Bureau recognizes that a smart borrower compares offers, and it doesn't punish you for doing exactly what every financial advisor would tell you to do. That window is 14 days under older scoring models and 45 days under newer ones. The credit card world doesn't get the same treatment, which is why you shouldn't apply for 5 cards in a week. But for big loans, shop aggressively within that window. The monitoring piece matters more than people expect, not because watching your score is inherently fun, but because the bureaus make errors at a rate that should alarm anyone who's looked into it. A 2021 study commissioned by Consumer Reports found that 34% of consumers who checked their credit reports found at least one error. That is more than 1 in 3 people walking around with a score that doesn't accurately reflect their actual behavior. The errors range from accounts that don't belong to you, to payments reported late that you have documentation showing were on time, to accounts that were settled but still show as open. Every American is entitled to one free credit report from each of the 3 bureaus every year through annualcreditreport.com. Pull all 3. Look for anything that doesn't match your actual account history. Dispute what's wrong. The Bureau is legally required to investigate and respond within 30 days. Freezing your credit is also something worth doing the moment you're not actively applying for anything new. A credit freeze, which is free at all 3 bureaus by law since 2018, locks your file so that no new hard inquiry can be run without you explicitly lifting the freeze first. It takes about 5 minutes per bureau to freeze, and about 5 minutes to temporarily lift when you want to apply for something. It does not affect your existing accounts. It does not hurt your score. What it does is make identity theft dramatically less useful to the person attempting it, because even if someone has your social security number, they can't open a new account in your name if your file is frozen. Given how many data breaches have hit major institutions in the last few years, a freeze is the single cheapest, easiest form of credit protection available. The deeper frustration with the credit system, and I think it's a legitimate one, is that it was built around a very specific financial life. One where you start young, you get a credit card in college, you carry a small balance, you pay it off, you repeat for years. If your life didn't look like that, if you grew up in a household where credit was avoided or inaccessible, if you're an immigrant whose credit history in another country doesn't transfer here, if you went through a period where the basics took priority over building a credit file, the system treats you like you're starting in a hole. That's not a personal failure. That is a structural design choice that benefits people who are already inside the system. Knowing that doesn't fix it instantly. But it does mean that every decision you make from here forward is working against a headwind that has nothing to do with how capable or responsible you actually are. The practical takeaway is that the headwind is manageable. 6 to 18 months of deliberate, boring action. 1 card used lightly and paid consistently. 1 credit builder loan or authorized user account. Utilities and rent reported where possible. Utilization kept low. No unnecessary applications. And most people who start from nothing can cross into a functional credit tier. The people who stay stuck are almost always stuck because they didn't know the rules, not because the rules were impossible to follow. And the people who move fastest are the ones who understand that they're not rebuilding trust with a bank. They're generating data points in a formula. Feed the formula correctly.